Hey everybody, welcome back. There's only one reason we save money. Only one. And that is to spend it at some point in the future. So when it comes to retirement planning, there are a ton of different ways that you could go about saving or accumulating your growth. But if the only purpose is to save it, is to spend it in the future. Doesn't it make sense that we should spend some time figuring out what it looks like when it's actually time to spend the money? See, that's what we're going to talk about today. This is a part 2 video where part 1, we were doing a comparison of 2 different strategies for preparing for retirement. One person was accumulating inside of a permanent life insurance policy that has cash value, and the other person was buying a term life insurance policy and investing all of the rest of their nest egg into the S&P 500. So it's a buy term, invest the difference versus permanent life insurance conversation. That's what we're going to dig into today. Buckle up and let's get started. So the contest that we put together, just to kind of get a feel for how this comes together, is we're visualizing somebody who has a 20-year window to retirement. So in our case, a 45-year-old male with 20 years till age 65. So pretty critical planning window. We're giving him a $20,000 annual budget, all in. Okay, so this is pretty common where you see somebody that has been raising kids and paying bills, and maybe their retirement savings hasn't caught up to where they want it to be, but maybe now they're getting to the point where they're over the hurdle and they've got some extra money, their career is going well. So a $20,000 budget is what we used. And just to kind of quickly recap, this gentleman had the option of putting $20,000 total, but to protect his net worth and nest egg along the way in his family, we need life insurance coverage. So in this case, we bought a 20-year term policy for $1 million. That premium was $1,078 per year. Very cost effective, right? So just a recap of how it went for him. By the end of the 20-year period, at the point where his $1 million term policy went away, he was left with the nest egg that he had saved in the market, which in this case was $817,000. So it's an enormous pile of money, and I think anybody would feel good about saving that amount of money. But let's talk about some things first so that we can think through this entire analysis as accurately as possible. When the term insurance went away, and I'm assuming because he's 65, he was cost prohibitive or health prohibited, so the insurance is kind of off the table now. Now the asset becomes the insurance. So the $817,000 is the asset that has to generate the income for the married couple while they're living in their retirement years. It has to also be the income that carries on in case there's a surviving spouse to fund the remainder of her retirement. And then if there's any legacy that you want to leave behind for your kids or church or charity, all of those jobs now belong to this portfolio of $817,000. So when we lose the $1 million term policy goes away. A couple things. We are out not only every dollar we ever sent to the insurance company, in this case over $20,000, but we're also out the opportunity cost. What could that $20,000 have done had it been in a better investment account, or had it been achieving some other financial goal? So we always want to make sure we understand opportunity costs when we make financial decisions. So in our case here, we ended up with $817,000. And now I'm going to switch over to the gentleman on the whole life policy. I would first just kind of remind you that the average rate of return during this period of time, this was 1999 to 2018. The average that the market returned over that time was 7.1%, which makes a lot of sense. When you hear people talk about the market and the stock market, that's a very common number to ascribe to an investment. So if you're going to invest long-term in the market, 7% is a pretty common target. 6 to 8 is kind of normal money, but 7 is right there. So in our case, we had a 7%. That's what led us to the $817,000. Now a quick recap of how the guy did with his whole life insurance policy. Same situation, $20,000 to put away, and do that all the way up until age 65. And in our case here, we're left with a death benefit of $1.4 million and a cash value of $590,000. And that, my friends, is generally where the analysis stops. People will say, oh my God, I did much better in the market. The rate of return on the cash in here was no good, and this whole life stuff doesn't work. It's trash value whole life. There's more to this conversation than meets the eye. And how do you judge these is based upon how well they do the job you need them to do for you. So in our case, what do we need this money to do for us? Again, we need it to fund our retirement, we need it to fund our legacy, and we need to protect anybody along the way if it doesn't go the way we hope it goes. So with a $1.4 million death benefit compared to an $817,000 portfolio, if something happened where that was the last year of your life, unfortunately, you're leaving your family substantially better off. So I'm doing this analysis from retirement date forward into the future. So a $1.4 million death benefit, $590,000 cash value. Everybody wants to compare the $590,000 cash value to the $817,000 portfolio final balance. So are we really getting the whole picture when we just look at those things? So the next step is to be, what do we need these things to do for us? And this is where we're going to pick this one up from moving forward. When you get to retirement, and now it's time to start generating income from the assets that you've created. This is a part of retirement planning that doesn't get a whole lot of attention. Everybody gets that you have to save. Not very many people understand what it takes to actually create the income in retirement. So this analysis is just designed to show you how each scenario works. It's not necessarily saying one is better than the other, or there's a lot of variables here, but I want you to understand that there is a viable alternative to the market when you're talking about saving for and spending during retirement. So when we first start retirement, remember when we said that the rate of return on the market was 7.14 on average? When we're accumulating wealth, average matters, because no matter what route you take to get to that 7%, no matter what returns you get along the way, it's the average. Everybody who averages 7.14% will end up at the same final balance. That's the accumulation side of the equation. We're now talking about the distribution side of the equation, and that's really what retirement is. So the first thing I want to tell you is when you're now withdrawing money from the account, it's not the average market returns that matter to you anymore. It's the order in which you get those market returns. So here's an example where we start off a portfolio, and the line along the top is a lucky retiree who gets good market returns early. And when you get good market returns early, it's a very powerful effect, and you end up with substantial money left over in a lot of cases. But what if we got the same market returns but in reverse order? So now in this case, we're getting, instead of this negative 12 here, we're going to move it over here, and it's a negative 12 at the front end of retirement. This matters because now you're starting off not only withdrawing money from the portfolio, but the market's also taking it away from you as well. It's a very powerful 1-2 punch that is really hard to overcome. So when it comes to retirement planning, and when it comes to generating income in retirement, there's some things that I don't feel get enough attention, and here's one of them. This is a tool, a study that was performed. It's called the Trinity Study for Safe Withdrawal Rates. And what they did is they looked at how do you draw down a portfolio of varying sizes and shapes and constructs, and over what period of time? What amount can I withdraw from that portfolio each year and still have at least $1 left over at the end of my time period? So in our case, we're going to be talking about an age 65-year-old starting retirement, planning to age 90. So that's a 25-year retirement. So let's take a look at what this study showed about a 25-year retirement window. So here you can see there's different types of portfolios across the top. So the computers have made it easy to study all these things. It was done before I knew how a computer worked, but thank God somebody was smart enough to do this. But all of these different configurations, 100% bonds, 75% bonds, 25% stock, 50-50. The other way, 25% bonds, 75% stock, or 100% stock. And how you should position these portfolios, there are as many opinions out there as there are people. I hear rules of thumb, it should be your age minus yada yada, and that's your bonds. Here's what I want you to understand. There's some realities to this stuff, and there's a lot of data to support what these studies are showing. So in the event of turning 65, and now we're going to start using our portfolio and draw down or withdraw money from it, the question and the challenge really is, how much can I withdraw without running out of money? So I'll bring your attention to, these are rates of success. So in the computer modeled simulations, what you're looking at here is the chance of success of having $1 left over at least, and that would be considered success. So the next question is, what level of success or what level of failure are you comfortable with? So in the event of a 4% withdrawal from a bond portfolio, you have a 78% chance of success or a 22% chance of failure, 1 out of 5. Most people would not get on the airplane if the captain came on and said, hey, I've got a 78% chance of getting you safely to Orlando today. Welcome aboard. So do you take that different with your family security, your financial security? Most would say no. So the next row here is taking a 5% withdrawal. And in each of these cases, here's the success rate. And I'm not sure if any of those numbers are acceptable to you, but this is kind of pushing it. And in retirement planning, many advisors out there will tell you you can sustain a 5% withdrawal rate. And there are products built around having guarantees with 5% withdrawal rates. There's a lot of pressure on those at present, and a lot of the companies are scaling back those benefits to reduce those benefits because it's pretty hard to maintain. So in the case of a 5% withdrawal rate, a typical retirement portfolio of 50-50 stock bond is an 85% chance of success or a 15% chance of failure. So when I looked at this and when I wanted to run this comparison for you, that's kind of what I figured I would show you, is this 5% withdrawal rate from the asset portfolio, the S&P 500, and we're not making any changes to it, so we're really looking at the 100% scenario. So a 82% chance of success. But that also means there is a chance of failure. So let's take a look at how it works when we go to get income in retirement. So what we're doing here is we're asking, with any given set of market returns, and again, we use 1999 through 2018. So what you're looking at here is your age or the years of retirement, where you start from a beginning account balance each year, the rate of return that the market earns that year, any fees associated with the investment. I used a 1% fee on assets. So you may say, I manage my own assets, I don't pay anybody else to do it, and that may be true, but across the board, a 1% asset management cost, I think, is pretty conservative, and I'm okay with that right now. The taxes, the annual taxes that would come out as a result of your account being in the market and getting dividends and short-term capital gains and some long-term capital gains. So the taxes are taken here, and we're taking that from the same account. Now, here's your withdrawal. Remember we said he had $817,000 in the asset account? Well, 5% of that is what's represented here in the 40,000 some odd withdrawal. So your balance is over here. So what should immediately come to your attention is the green numbers means there's money. When the green turns red, guess what that means? You're out of money. So in this particular case, this person ran out of money at age 83, and I lost my eyesight about age 53. So this is not how people would normally live. Okay, people don't just start out and say, I'm going to take a 5% withdrawal each and every year. There's some rules to how you start the withdrawals and when you adjust, but my point is, if you're looking to stress test a certain method, this is a good way to do it, because these are actual market returns. And you may notice that, hey, during that period of time, look at what the market averaged, 9.2%. So if the average is 9.2%, Mark, how come I can't take 9.2% out? And it goes back to those sequence of returns. In this particular case, early in retirement, we had 3 down years. That's likely, guys. That happens all the time. But what's even worse is We showed up with the end of the first year of retirement and we grew our $817,000 to $891,000 while we took our withdrawal. So at the end of the first year of retirement, we're feeling pretty good about ourselves. We're at cocktail parties telling people that, we're beating the market and Warren Buffett's got nothing on us, and you're feeling really good about it. The problem is those next 2 or 3 years takes you from 890 down to 450. So let me ask you, at what point would you panic and pull out of that market? At what point would you adjust your withdrawal rate and hence your standard of living, your retirement income? That's more like it. That's what's more likely to happen. People will panic. People will pull their money out of the market. People will cut back on what they're spending. And that's not a desirable outcome. We're trying to maximize. When we put together strategies, we want to maximize every potential that we can. We want to maximize our income. We want to maximize our survivor income. We want to maximize our legacy for our children. These are all things that if you don't set it up properly, you don't get a lot of do-overs. And one thing to think through on this, the money life cycle is a 3-period game. In the first period, you're accumulating. That was what the last video was about. So there's tips and tricks and watch outs and gotchas while you're in the accumulation years. The second period of life is the distribution phase, or what we call retirement. Now you're living with what you built. We used to get pensions. People would work for a company for 30 years, get a gold watch and a pension, and die 2.8 years later. It's not the world we live in anymore. And then we went through a period where companies were starting to scale back dramatically on pensions because they were grossly underfunded. And then they pretty much, for the most part, gave up on them and kind of said, you do it. And that's where the 401k comes from, and the individual retirement activity. All of those things are self-serve. You got to do it on your own. And a lot of people are pretty well versed on the accumulation side. It's that next phase, distribution, that can really get you. And you got to win in all 3 periods, right? Michael Jackson had a heck of a accumulation run. No retirement, obviously, died prematurely, but guess what? No estate plan, nothing. His money got taken by accountants and lawyers and agents and everybody, the IRS. Everybody had a field day, not the Michael Jackson family. Right? So all 3 phases we're looking for success. So again, in our case here, when we're drawing this down, at what point do you panic? And remember, this is the money that has to do everything. So when you get down here and we're 10 years into retirement with $440,000, that is now a 10% withdrawal on that sum of money. And we know that's not very sustainable. And by the way, the 10% withdrawal is what I hear Dave Ramsey tell people that they should be able to get from the market if they're in good quality mutual funds. No reason why you can't take 8 to 10%. Well, let's look at that. At the 10%, according to this study and actual market returns of the S&P 500, the best we do is a 29% chance of success. That's the best. There's always going to be outliers, and there's averages and lots of statistics about some do higher, some do lower. But guess what, guys? You don't get to live on the average. You don't get to know any of this up front. You live on the actual, and it's playing live during game time. It would be nice if somebody would lay out for you what the next 20 years look like in the market. We could all do really well. But since that's not how it's played, you're kind of stuck with your best guesses. So that withdrawal rate is unsustainable, and you can see pretty readily that it doesn't last. So now let's talk about the other part of things. So in the whole life, remember, we had ended up with just over 1.4 million in death benefit in retirement. But in this case, I wanted to show a different approach. And this is an option that's available. Not many people talk about it, but please understand, there are a lot of design considerations that go into structuring a proper whole life policy. Okay, this doesn't happen by accident. This is picking the right carriers, which my vote goes towards mutual carriers, where you as a policyholder are also part owner of the company and participate in the profits of the company, which are dividends. So our column here for dividends, this is the money that the company earns as profit, and it returns to the policyholders according to a dividend scale. How long you've been into the policy, what your cash value versus your death benefit is, what's your health rating, all of these things, but these are all figured out up front. And this is projected using today's current dividend rates. So do you believe interest rates and dividends are going to go up from here or down? We've been sitting on the bottom for years. We're now starting to see interest rates climb again. But that bodes well for the dividends for the life insurance company, right? Because when you send your money in as a premium, that money goes into the insurance company's general account. The general account is invested in securities, typically bonds, mortgages, not the stock market, but safer stuff. And they've had a hard time getting good yield or good interest rates on their new money with interest rates at the bottom. Now that they're starting to come up, the new money going into policies are earning higher rates. So that bodes well for this type of strategy. And this strategy was, we're going to fund it until retirement. But then if insurance is not my main priority, it's a priority, but it's not the main priority. I really want to get as much income out of this policy as I can. One example or one way to go about that is to tell the insurance company to take the policy to reduce paid up. Reduce paid up means, see my total premiums going in? Well, they stop because I've told the insurance company I want to be done, contractually done. No more premiums. Everything's still guaranteed. So my death benefit goes from 1.3 million to 902,000. Okay? Now, my cash values are what is really going to start generating this income, because the income is composed of a distribution of the cash value plus some combination of next year's dividend and a couple other factors. You don't have to get too technical here, but the point is this is an asset that doesn't go down in value, and that's probably the biggest key difference. What makes the market complicated is not that it goes up, it's that it goes down. And we like it to go up when we're accumulating. We like it to stay up when we're in retirement mode. But a down market is different for a retiree than it is for a consumer who's saving for retirement, right? So if the market cuts in half and you're accumulating, it's a 50% off sale. You know, nobody shows up for that sale in our industry, but it's a 50% off sale, and it's a great opportunity. But if you are the retiree, that 50% off sale just took your lifestyle away from you, and you don't get the do-overs on that. So in our case over here, we've asked the insurance company to tell us what's the maximum amount of a advance or a loan against this death benefit that I could take and sustain the policy till age 90. And this is nothing fancy. This is not, there are policy designs. There are things that I could do to really improve the income and the cash value. I can improve the death benefit. So there's a lot of different ways I can change this design to fit a specific goal or objective. This is just a straight, run-of-the-mill, solid company whole life policy, paying us dividends. So my income over here is $35,479. And as you watch, as we go through this, the $35,479 is able to be sustained under current conditions, current dividend scales, and it lasts till age 90, just like I asked it to. And then at the end of that period of time, I still have about $160,000 left over that would be a tax-free death benefit to my family. All of these income streams, every year I'm taking this $35,479. Guess what? That is tax exempt, meaning there's no place on a tax return to even put it. Do you think taxes are going to go up or down over the next 20 years? If there was a way to fund your retirement with no risk that the market and the government are going to get greedy and take your money, this is something you should look at. These are all tax exempt loans against your eventual death benefit. So what you're doing is you're making yourself and your spouse the primary beneficiary of your own life insurance. A lot of people say, hey, I don't want that because I don't get it, and it goes to my family if I'm dead. All of those types of comments. Well, that's not true. If we design this correctly, not only will you get every penny back out of it that you've ever put into it, you'll probably recover most of the taxes that you paid during your retirement. So in our case, this $35,000 lasts until age 90. I've got 160 left over, and that is under today's market conditions. The word non-guaranteed across the top matters because dividends are not guaranteed. These are projected, right? So the market could go up, the market could go down. I gave you exact market numbers, so I feel pretty confident about that. But I want you to understand these dividend numbers, these are not guaranteed. These are projected. They're pretty accurate for the most part because that's how you pick a good insurer, is by the strength of their dividend paying abilities. But for our purposes of accumulating safely, having maximum distribution of income, and having max tax efficiency, this strategy deserves a look because we've had some really good markets as of late, but we know there's a correction coming. Do you know when? If you did, we could do a lot better, but guess what? Nobody does. And we don't control the market. Market could go south if a bomb falls in the wrong country at the wrong time. And the big lesson here is your retirement happens on your schedule. So you don't get to pick what the market is when you retire. You don't get to pick what the tax policy is when you retire. You don't get to pick what the tax rate is when you retire. So all of those things should lead you to at least become curious as to how this alternate strategy could work for you. I hope you found that useful. Drop a comment below. Let me know what you want to see. Thank you.